Welcome to this explainer. Today, we're diving into the really fascinating concept of diversification. And we're not just talking about, spreading your stock picks around. We're zooming way out to the macro scale of ancient biological evolution, and then bringing it all the way down to the micro, those tactical decisions you literally have to make with your cash today. It's basically a journey from the origins of complex life straight to your retirement account. Let's get into it.
So, here's our roadmap for today. We'll start with nature's ultimate diversification strategy, move into the time diversification debate, look at gliding through the life cycle, and finally, tackle those tactical decisions. Do you invest now or later?
All right, kicking things off with part 1, nature's ultimate diversification strategy.
Picture the Earth over 500 million years ago. Life was, pretty simple. But then, starting roughly 538 million years ago, nature pulled off the ultimate diversification strategy, the Cambrian explosion. Suddenly, we didn't just have simple cells anymore. We had bizarre creatures with compound eyes, armored plates, spiked tails, the whole shebang. Practically all major animal body plans, or phyla, just started appearing in the fossil record out of nowhere. Nature didn't put all its evolutionary eggs in one basket. Instead, it rapidly branched out into complex life forms to ensure that no matter what planetary disaster struck next, something was going to survive.
When we map out that timeline, you can see exactly how fast this happened. Over just 13 to 25 million years, which, trust me, is an absolute blink of an eye in geological time, life diverged wildly. And those surviving lineages, they shape our entire ecosystem today. This whole biological blueprint for risk mitigation, adapting to a completely unpredictable environment by spreading out your bets, is actually a direct parallel to modern financial theory.
Which brings us to part 2, the time diversification debate.
Now think about the number 60, specifically 60 months, or exactly 5 years. In financial circles, this specific window is frequently cited as the quote-unquote magic number, where the risk of holding volatile equities just statistically collapses. But why 60 months? What makes it so special?
Well, if we use a framework called almost stochastic dominance, which is basically just a fancy mathematical way of finding the most rational bet, the data tells an incredibly compelling story. Think about it like this. If your investment horizon is only 1 month, buying stocks is essentially a coin flip. You've only got about a 67% chance of beating bonds. But watch what happens as time expands. At 48 months, rational efficiency shifts aggressively towards an 80% equity allocation. And by the time you hit that 60-month horizon, the historical odds of stocks outperforming bonds skyrocket to an astonishing 98 to 99%. The violation area, meaning the statistical likelihood you'll actually regret holding stocks over bonds, shrinks down to a negligible 0.24%. It's wild. Short-term volatility stops being this scary risk and literally becomes the mechanism for long-term compounding. Now here is where things get really interesting, because there is this massive tension between the math and the real world. On one side, we have academic math, championed by Nobel laureate Paul Samuelson. He proved what's called the fallacy of time diversification, basically showing that just adding time to an investment doesn't inherently reduce your total variance unless bad returns are guaranteed to be followed by good ones. And since markets definitely do not guarantee that, pure math says risk doesn't just vanish. But on the other side, we have empirical, historical market data staring us in the face, showing a massive drop in real-world volatility and regret after 60 months. So we're left with this fascinating clash between theoretical math and historical reality.
Let's move into part 3, gliding through the life cycle.
To actually resolve that tension between the rigid math and the historical data, we can look at a strategy that adapts to our changing environment. Kind of like our biological analogy, right? Organisms surviving by adapting to their specific stage in the ecosystem. A glide path perfectly maps out this transition. A portfolio seamlessly transitions away from volatile, high-growth equities when you're early in your career, when you have decades to recover from crashes, all the way down to stable treasury bonds as you approach retirement. You are systematically de-risking as your human capital, your ability to actually go out and earn a paycheck, starts to diminish.
But even within that glide path, you've got tactical choices to make. Let's compare 2 different personas from the research. First, we have Emma. She uses a growth accumulator strategy, meaning she reinvests all her dividends and interest. By year 35, she's built this massive $1.29 million portfolio. Then we have Jack. He uses an income builder strategy. He completely skips reinvesting his dividends and chooses to spend them instead. Now, his total portfolio value ends up lower, around $1.02 million, but look at the trade-off. He gives himself over $32,000 in yearly spending flexibility without ever having to sell off his core assets. It just goes to show that the right strategy depends entirely on the specific financial ecosystem you're trying to build for yourself.
And finally, Part 4. Tactical decisions, now or later. This brings us to a really critical question for literally anyone sitting on some cash right now, maybe from a bonus, an inheritance, or selling a business. Do you deploy it all at once in a lump sum, or do you trickle it into the market over time to avoid the risk of buying right before a market crash? I mean, it's human nature to want to dip your toe in and ease into the water, right? Well, Vanguard actually ran the numbers on this, and the research pretty much settles the debate. Lump sum investing maximizes your time in the market. Historically, deploying your cash immediately beats a 3-month cost averaging strategy 68% of the time. The logic here is actually pretty straightforward. Markets go up more often than they go down. So every single day you're holding cash, you're paying an opportunity cost by missing out on the market's risk premium.
Let's put that into perspective. If we break down the one-year wealth outcomes based on a $100,000 investment, it becomes super clear. In great markets, the 95th percentile, and even average markets, the 50th percentile, lump sum investing simply leaves you wealthier. Cost averaging only mathematically protects you in the absolute worst 5th percentile of historical market environments. So unless you're absolutely convinced a historic once-in-a-generation crash is happening tomorrow, or your personal fear of loss is just so paralyzing that you'd leave the money in a savings account forever otherwise, trickling your money into the market is mathematically costing you wealth.
So bringing it all back together, just as the species that survived the Cambrian explosion successfully adapted to their environments by branching out, your financial strategy has to be uniquely tailored to yours. Diversification isn't just about what specific stocks you buy. It's about matching what you buy with your time horizon, shifting your assets as you age, and really understanding the statistical realities of when to deploy your cash. I'm going to leave you with this final thought to chew on as you review your own accounts today. When you look at your unique financial ecosystem, are your assets properly diversified to just merely survive, or are they built to truly thrive over the next 60 months? Thank you so much for joining me for this explainer. Catch you next time.